All right, guys. In the previous video, we looked at the accounting equation. This is what we looked at. We had 10 different transactions, and then we recorded them on our accounting equation. So now I want us to now take these transactions and then record them in the general ledger. So you will see how these transactions gets recorded in the general ledger. This is general ledger. So in the general ledger, each account will have its own account. Okay, yeah. So each account will have its own account, and then you record all the transactions that went into that account, and then you close it off. So there's a first transaction. If you remember, let me just go back. You see here, we receive 1,000 rand from a customer for services rendered, right? So we said uh, our bank here was increasing, and we said the bank increases on the debit side. So you'll have 1,000 rand here. It's that simple, but you must remember that you can't just have one side of entry. There must always be two. So already we saw that, okay, another leg here was equity. And equity was your retained earnings. So, and then you then credit 1,000 rand. So then you are now in balance because you have a debit and you have a credit. You cannot balance if you have just a debit. You have to have both of these. You have to have it on both sides. So these are the two accounts that were affected. It was a bank. Our bank received money, and also our services rendered. It also increased. We received money. This is like sales. This is basically like sales. And your ledger is done. You then move on to the onto your second transaction. So in normal circumstances or in normal situations or in practical, most companies they would have thousands of transactions, right? So in this case here, we just did like these few terms, and then we're gonna close off based on these terms. So every month the company would record its transaction, and then they will close them off at the end of each month, and then they will see what the balances are. So I'm just gonna move quickly. Let's move on to the second one. That 5,000, what was it for? They purchased inventory on credit. They bought stock basically. Every time when you buy a stock, it's an asset, and we already know on which side our assets increase. They increase on the debit side. So now you come and then you put it on the debit side. Oops, not 500, it was 5,000. Then again, you have to find another leg because you always have to have a debit and a credit. And then they bought it on credit. So our liabilities are increasing. So we will have to have another account here. Then we're going to call it liabilities. These are the people that we owe money. I'm going to delete this. And remember, when you increase them on the credit side. So then this one will come on the credit side. And then you're done with this entry. You bought stock, which is an asset, and assets we said they increase on the debit side, and then your liabilities they increase on the credit side. These are the rules that you need to know. On my previous videos, I emphasized that you really try to memorize it, find a way of knowing which side assets increase, which side the liabilities increase. Because if you know which side the assets increase, and then for you to decrease them, it's an opposite of it. So for instance, stock, we know it's an asset, they increase on the debit side. So for instance, if you then say, okay, no, I want to return this stock wasn't good, some of it was damaged, then you then put it on the credit side because on the credit side, that's where you reduce your asset. It's that simple. Same with liabilities. Every time when you go and borrow more money, you put that money on the credit side, and then when you start paying those people, you put it on the debit side. It just goes like that. Okay, I don't want to make this video long. I'm going to try to make it as short as possible because we've already done this part. I remember we discussed the debits and the credit on the previous video when we were discussing equity. The third one, let's see what the 10,000 was for. It was a loan. A company pays off a loan. So now we are paying off a loan. So when we're paying off a loan, again, it's an asset. Our bank balance reduces it. And if you want to reduce your bank balance, you put it on the credit side. There you go. Let me just, I want to. I just want to have a standard format in all these things. Just a sec, I want to fix. Oh, it doesn't work here. Let me just fix it like this. I can put it all the way down, all the way down, all the way down. Okay, that's done. So we repaid one of our loans, which was 10,000 that we were owing 10,000. So when we repay a loan, we then credit our bank because the bank is losing out money, and then we set our liabilities, they decrease on the debit side, right? Then you're done. So this one goes with this one, so you have both debits and the credit. So you're done with this one. Then let's look at number 4. Number 4 says we sold merchandise for 2.5 in cash at a price higher than the cost price of goods sold. Okay, so there's actually two transactions that are affected here, but the question is not clear if we should record the 1.8. Right, so firstly, let's first sell the merchandise. So we're selling the merchandise for 2.5. So when you sell the merchandise, it says it was sold cash. So our bank received money. So if obviously it's an asset again, it increases on the debit side, it received money. We sold our merchandise. And also what happened there? And then our equity also increased, which is our sales is 2.5. There you go. So you're done with this one. If you have any questions, drop me a message at the bottom and then I'll reply to your questions. Let's look at the fifth one. The fifth one was the company. Okay, these are salaries. They paid 3,000. And again, if you're paying out, the bank balance loses money. So you put it on the credit side. And then the account that gets affected is salaries. Okay. So we're gonna have another account for salaries. It's salaries or maybe let's say salaries and wages. Just say salaries and wages. I'm gonna delete these ones. There was nothing on this one. It was 3,000. So we said the bank lost money, and because salaries are expense, they increase on the debit side, and then you're done. You move on to the next one. What was 7.54? 7.5. We bought a new piece of equipment. Okay. Again, gonna open a new account for equipment. Then we're gonna say here equipment. Then obviously we're gonna delete this new. We bought a new equipment. How much was the equipment? 7.5. Equipment is an asset, so the assets they increase on the debit side. And then 7.5, our bank balance lost money, so our bank lost money 7.5. You then credit it here. And that's it. We're moving on to number 7. What happened? A company received a bill from the supplier. So, okay, here, so they bought something on credit from the supplier. Again, our supplier is our creditors. They increase on the credit side. And then we bought what? Office supplies. They bought office supplies, so you can have an account for office supplies. This is an expense account, and the expense account, they increase on the debit side. So you just come and then you put it on the debit side. Make sure that also your liabilities are increased. There it is. Then we're done. We're moving on to the next one. What's it? 2004. 2000 was for what? A deposit for future date. So this one is what we received from the customer. Every time when you receive money, our bank balance will increase and they increase on the debit side. And then I said this one, I'm going to put it on the liabilities because we owe this customer. We haven't really delivered that. So it's part of our liabilities. So our liabilities are increasing. Let's look at 1.5. What was 1. A company pays 1.5 for rent for office space. Yeah, so we're gonna have an expense side for rent. Okay, let's have it like this. Call it rent. Rent expense, it already tells you that it's an expense, and we know expenses, they increase on the debit side. That's 1.5. Let me see. Company pays rent, 1.5, and then our bank balance loses money, and then we decrease it on the credit side. And we're done with this. And then the last one was the issue of shares. So I'm going to have a new account. Let me just put it here. I'm going to call it share capital. Okay, I'm going to delete the amount. Okay, so here we basically issued new shares. So basically, in other words, we sold part of our company. So the guys that bought in, they obviously giving us money. So this is an equity account. Equity account, they behave like liabilities. They sit on they increase on the credit side. And then also our bank also received money, and then we increase it on the debit side. Then we are done with the ledger. I'm gonna hit save, and then what you then need to do, you close off these accounts. Okay, I hope you don't get confused here. I just want to close them off. Maybe that's not the best way to do it. Okay, that's done. This is where this one ends. Okay. Okay, this one we didn't close it off. This is where now we put all the totals. Okay, this one I need to push it down, 2 lines down. Okay, perfect. That's fine. Okay. Maybe I can even make this even a bit bolder. Okay, that's about it. So let's first close one account, for instance, and see what we need to do to close it off account. There's also other things that I left out, the dates and all that, but obviously on our question they didn't give us the dates. But for instance, if the date happened on the 1st of January, you would have a date here, maybe 1 January, whatever, 2023, for instance. You'd have a date here basically, and then have a short description of what the transaction was for. But I think we're going to have another topic to show you this, but it's not really a big thing. I don't think they will mark you wrong. It will depend, but I will also show you how this works. I'm just going to leave out the dates for now. So when you get here, you sum up all these amounts. I'll quickly add them up. You first see which side is bigger. So obviously in this case, this side is bigger, and then you take the total on both sides, you put it on both sides, that's 3.5. Then here, because this side is short now of 3.5, so you then put the 3.5 here because it's short of that, and then we call it, this is a balance carried down. You then also take that same balance to the next credit side to say, okay, this is a balance that we're moving forward with, 3.5. Then your account is done. This is how you close it off. What we did was we looked at both sides, which one was bigger. We realized, okay, this one is bigger. Then we take the balance of the bigger side, we put it here on both sides, on both the credit and both on the debit and the credit. And then the side that is short, you then put the amount that is short there. Then now you have both amounts, and then you just bring in this amount also. This is a balance brought forward. Some call it brought forward or brought down. Again, you come here, you look at the on both sides, you see, okay, which side is bigger? 1.5 is a bigger side. Then you come and then you bring it here. And then you will also have it done. And then you then have a balance brought down of 1.5. but actually these amounts, they are the ones that go to retained earnings. So they actually go to retained earnings. It's not like you can move forward with them in next year. They actually go to retained earnings. We'll get to that topic. Now again, let's look at the bank. The bank is tricky because it's got entries on both sides. So you just sum up your both your debit side. You make your mental note to say, okay, debit has got 15.5. Let's see what credit has. Credit has 22. So then we take the balance for 22, which is the one that we use now. So it's 22,000. Okay, I should have left some space here for the balance carried down. So this side is the one that is short because it's smaller. So it's short of net minus. You can use your own calculator. It's just that I have an advantage of using Excel. It was short of 6.5. Let's check it. Yeah, when you add it together now, you get 6.5. Then you take your balance carried down, you move forward with it. The amount that was short of 6.5. So basically that's about it. So you do the same thing on all of them. I'm gonna leave this. You close them out. You close them off yourself. See if you can close them off, and then let me know. Let me know if you can close down. Let me just do the last one, for instance, so that you'll be comfortable. But I'm gonna leave the rest. You close them off. So for instance, here we know it's 10,000 that is bigger because there's nothing on the other side. So it's 10,000 on both sides. So your balance carried down, it's 10,000. It's short of 10,000. Then your balance brought down, it's 10,000. This is what you'll be moving forward with, 10,000. So yeah, so what you need to do, finish these questions. I think I don't know how I can attach these on your, I'll see. Just make a screenshot of these now, and then as they are, and then close them down yourself, and then see if you are coming all right. So yeah, no, that's it for this video, guys. Thank you so much. Please stick around. There's a lot that is coming. I'm also gonna have quiz questions that that will test your knowledge. So just stick around for now. Not well for now. Just stick around. You're really gonna have fun, and you're gonna know accounting. I don't want people who will just do this for passing. I want people who will really want to know accounting. I myself an accountant myself, so I work as an accountant, so I know what I'm doing here. It's something that I also work with. So there's really a lot that is coming. There's a lot that is coming. Like I said, here this thing is for people who really want to be accountant, not just people who want to pass it. So stick around. There's a lot. There is a lot that is coming, and yeah, I'll share the details later. But if you want to be an accountant, this is the right platform for you. But even if you don't want to be an accountant, then just stay for your knowledge. Then thank you so much. That's it for now. Bye.